The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Tape. My name's Gaurav Sodhi. Joining me today is analyst Nick Cummings. Hey, Nick.
Hi, Gaurav.
And all the way from Assassination Capital is Graham Wickham.
Hey, Gaurav.
All I'm hearing in the news, Graham, it's like terrorists getting murdered by governments responding, ambassadors being pulled. What is going on over there in Canada?
It's the Wild West over here. Vancouver is,
I always suspected. Now it's been confirmed. There you go. Where exactly were you, Graham? When
it happened.
Okay. Yes. Right. Well, we've got a couple of topical things to discuss today. The top of mind really is the disaster swiftly unfolding, perhaps continuing to unfold at Star Entertainment, a stock that, if you had told me 2 or 3 years ago that this thing would be trading at 60 cents or maybe less than 60 cents, I just wouldn't have believed you. I thought there would be no way that could have happened. And yet here we sit. So Graham, tell us the latest fiasco with Star, and then maybe we can start to unravel how the heck we got here.
Yeah, I mean, it's just a mix of, do I want to feel sorry for this stock or what have they done to themselves? It's just been one bit of bad luck and bad news after another. The latest thing is that they're raising capital for the second time in under a year to repay a bunch of debt that they had coming due kind of early next year.
Really?
So, yeah, they had an $800 million capital raising back in February, and they're now raising another $750 million now, inflating the share base by 77% or so.
Wow.
And diluting all the shareholders in the process. And maybe we shouldn't talk about this on the podcast because it just grinds my gears that the CEO making these decisions doesn't own a single share of stock.
Yeah,
so he isn't impacted at all. He's got all the upside, none of the downside.
Yep.
And it's just a classic example of the difficulty of valuing businesses when the CEOs don't have skin in the game. Because we could do all the maths on Star, run all of our valuation techniques and come up with a number. But when CEOs can do this kind of thing, it changes the equation in kind of an unpredictable way. That Star continues to look undervalued. But as long as management doesn't really care about shareholder dilution, it's very difficult to come up with a number that really reflects it being undervalued. So, yeah, bit of a tricky situation.
I can't help but comparing it to what's happened with MinRes over the last few weeks. Mineral Resources, of course, stock that we've liked for a long time. They went to the bond markets and raised over $1 billion in the US bond markets. And there was some speculation that MinRes was going to raise equity. And it has an enormous CapEx requirement over the next 2 years, and probably more than $2 billion than just been over the next 2 years. It's a $10 billion business. So it's a considerable amount of money that they're spending. And they've already got a fair amount of debt. So there was some chatter that they were going to raise capital, but because Chris Ellison owns, I don't know how much, a huge amount of stock in that business, he just does not want to dilute himself. So he's managed that share count really tightly, and that's the difference you get from someone who thinks of himself as an owner of the business. And you listen to Chris Ellison speak, and it's always his business. You know, it's his business and his passion. He started with his credit card. $10,000. It's now a $10 billion business. He's everything of himself is inside this business, right? It's such a different way of running things than, a CEO is parachuted in from another company, sees risks and tries to solve problems with complete disregard for what that does to legacy shareholders.
Yeah. Objective is a similar case where
Objective's a good one
the
as well.
CEO owns a ton, and so of course he doesn't take these kind of decisions lightly. But in Star's case, Cook has come in and he he's solving the problems, but he's solving them in a way that, I mean, it really didn't. What kind of frustrates me with this one as well is that it didn't really need to happen. They had a perfectly reasonable plan of selling some of the assets and then leasing them back, some of the property portfolio and then leasing it back. Would have patched up a ton of the debt issues that it had, and you wouldn't have this kind of dilution.
So why did they do that, Graham? That sounds like a very reasonable thing to pursue.
Well, yeah, to me it was on track. Everything seemed like it should have gone that way. They tried to sell Treasury before, and then the deal fell through. I can't quite remember why now. But then, yeah, I mean, they've still got other assets that they can work with. They'll try and resell Treasury. So I think this was just an easy, quick fix. Maybe they felt that the deadline was coming a bit too close to refinance, and so they didn't want to push their luck. But yeah, I mean, this was just a savage capital raising. They were raising it at such a low price, such a low valuation for the business, and
it's actually hard
diluting everyone in the process.
There are some cap raises, some dilutions that you just cannot recover from. It permanently increases the share count so much. I can't see how they recover from this. I think this is a lost cause now. I mean, I agree. I think that between these two capital raisings, they've inflated the share count so much that, yeah, realistically, it's not going back to $3 anytime soon. Well, I don't think it's going back to $2 anytime soon. Or,
I mean, that probably is the case. But I mean, it still looks undervalued today. That I could make the case for it being worth over $1 in the right light. Yeah. But so, yeah, I mean, at today's share price or at the issue price of 60 cents, it still looks like good value. But you just don't have that assurance that management won't pull this same trick again next year when it wants to raise capital to buy something or refinance or whatever. So, yeah, we decided in the end to, even though the stock continues to look undervalued and maybe some very risk-tolerant shareholders might want to continue holding or participating in the raising, there's just too much uncertainty around the business, the regulatory environment, management's kind of mishaps that it's hard to recommend it as a buy at today's price or recommend participating in the raising.
Nick, what's the key lesson here for you as an outsider who I don't think has ever bought the stock? I've never really heard you discuss it, so I assume you're not really tempted by it. But what does this tell you about either the business or the industry?
Yeah, I think for the casino industry or for a casino, it's essentially, particularly in Australia, a license to print money, or at least it should be.
It should be. That's what I assumed, yeah.
Yeah, and I think the lesson here is, even if it has that license, if there's debt on the balance sheet, no matter how good the company is, if there's debt on the balance sheet, you are beholden to creditors if things go wrong.
Yep.
And that's what equity holders are unfortunately finding out. I mean, I think I read back on some of our some Graham's research, and underpinning our thesis only a year ago was $2 worth of property on the balance sheet. And that property value hasn't changed, but now it's being shared with 60% or 70% more shares, and it's now worth 60 cents. And everything's gone wrong, but if you have debt on the balance sheet, at some point you're beholden to creditors if those things occur.
For me, that lesson cannot be learned strongly enough or often enough. The dangers of overburdened balance sheets, no matter how good you think the business is. A lot of the time we'll think, or management will say that the business is quite stable, it can handle a lot of debt. I still think we need to be very vigilant against these heavily geared businesses, because look what's happening here. Sorry,
yeah, and another example that you never thought was going to happen was airports and a pandemic.
Yeah, well, that's
again, a monopoly asset with regulated revenues. You think nothing can go wrong, and they can be geared 5 or 6 times to their earnings, but things do go wrong.
The one I was going to go with was Cleanaway, which a couple of years ago. This is a contracted business to local councils, a very stable revenue base, but they just geared themselves to their eyeballs, got into some sort of trouble with acquisitions. The debt means that you cannot make mistakes, and And simple cyclical downturns end up being balance sheet disasters, because then the debt becomes a problem. You have to raise equity at super low prices. And as we said before, that's it. I mean, you're permanently diluted and you'll never recover from that. That's certainly been the case for Cleanaway. And I think that's going to be the case for Star. So, Graham, when you're not sounding very enthusiastic here, this does seem though it's extremely bombed out. I can't imagine anyone wants to touch it now. But you're saying that's probably...
Yeah, that's the flip side. I mean, that is, I still look at it today and I can... It does look undervalued. That if you assume even kind of modest growth, if it cleans up its act, it gets through the AUSTRAC fine unscathed and all of that, it does look undervalued today. So people who want to take a punt on it or who want to participate in the raising and maintain their stake, then there are rational arguments for it. But at the same time, there's just so much risk still built in, particularly managerial risk, that if you're even a little bit hesitant with that kind of stock, or you're not going to be able to maintain your cool when the next bombshell hits, then it might not be for you.
For me, it's the calculus is slightly different. I just don't want to invest in a business where it's clear that management aren't acting like owners. I completely agree with what you said before, Graham, that there seem to be obvious alternatives. The business is sitting here with an enormous asset base. And instead of trying to monetize that asset base, which by default involves shrinking the business, you have to sell maybe the best part of the business, they went and destroyed, I think, any prospect of future returns by diluting so much at such low price. That's the management that has burnt bridges, and I cannot, again, almost at any price, go back and invest with them. And it might mean that you lose out on a double, but that's fine. I think sometimes you got these rules and they serve you well over average, and sometimes it means you don't make a double, and I'm perfectly comfortable with that.
Yeah, I think you're right.
What a somber story. I'm afraid the next segment is no sunnier than the last one. I listened to an ASX presentation from the ASX Mid and Small Cap Conference from a company called Superloop. And Superloop may be familiar to some listeners, members, because it used to be a darling. It was set up by Bevan Slattery, who's the founder of NextDC, Pipe Networks, Megaport. He's got quite a cult following in the markets, and this is one of his darlings. It was set up to build and own fiber assets. Several years ago, it built up a large collection of self-built fiber in Australia, and then a big bunch of fiber they built in Singapore and Hong Kong. And the idea was just to monetize that fiber. And I think what the business learned was that fiber isn't valuable in itself. Fiber is valuable if you have... It's like a road toll. If you have that monopoly connection from two places that really require connection, then it makes no sense to replicate, and your fiber becomes super valuable. But if you're just connecting fiber to areas that aren't in demand and aren't all that valuable, then your fiber is worthless. And that's exactly what Superloop found. They sunk hundreds of millions of dollars into building fiber that just did not seem it was needed or required at all. For me, this from the very beginning seemed like a company that was furiously trying to build something to sell something, the story to investors. Fiber is hot. We're building a lot of it. We're a fiber infrastructure business. We need infrastructure multiples. That was the narrative I was getting from the business. And of course, it all fell apart, collapsed. The shares the stock's been a disaster. They've had to sell all their international stuff and some of their local stuff, and it's now switched gears, and it's now an ISP. So it basically resells NBN. It's retained some of its fiber. So it sells NBN, but also has its own fiber they can piggyback off. So it should, in theory, earn better margins than the typical NBN reseller. I don't see that being the case so far. In fact, I think this is the inferior business to Aussie Broadband. But that's beyond the point. This presentation from the CEO, it was just... I was thinking about Superloop because I thought the business model has changed. They've got new management in charge now. Their financials are turning around. And so this might be a turnaround story. Often I find a business that's failed in its first version, when it then morphs into something else, bad memories, of the initial version stop people from buying it. And so it can be an opportunity if you're willing to be flexible. So I was listening to the presentation, and the management just said, we've had a bit of an interesting history, and went through
a journey.
We've been on an interesting journey. Thanks, Graham. That's right.
It's always a journey.
He went through and sort of talked about the business without any mention to Superloop 1.0, to any of the lessons they've learned, to the disaster that this business is, to the cost to so many people. Just completely ignored it, glazed over it. And then all his plans were all revenue targets, all financial targets. The transformation strategy is called double down again, it's called. And so the whole point, the whole corporate strategy is to double revenue. That is the corporate strategy. And the lesson from this is, if you hear a CEO talking about corporate strategy and it's all about financial metrics, we want to get our margins to this level, we want to get our revenue basis level, we want to grow to this size, just run a mile. The strategies, the transformation strategies that work are the ones that have something to do with adding value to someone else, that create value for a customer. And a good counterpoint to that is Telstra, which had its T20 strategy, which is really about reducing the complexity of the plans. And so customers were offered not 1,000 plans, but something like 20. It reduced its number of plans it had on offer from about 1,000 down to 20 something. And that's something that's worth pursuing. Other success stories have often used a benefit to the customer to drive improvement internally. So when I heard that this company is all about just doubling revenue, I just thought, I'm not prepared to invest in this. And I just wanted to make that clear, that we've looked at Superloop, the disaster's over, but I don't think recovery is underway, and I would not touch this business at all. But there's a perfectly awesome competitor in Aussie Broadband who's just doing all the right things. In fact, if you want to line up a good company versus a crap business, line up Aussie Broadband and Superloop, compare the two, and you have a perfect illustration of what good management looks like versus poor management, what a great business looks like versus a lousy business, and the kind of business you want to get involved with against one that you want to run far and fast from. That's the end of my rant. Thank you for indulging me. Guys, do you guys own or ever thought about owning Superloop?
I haven't. But I agree with everything you said. I had a look at their financials this morning, and the other thing they've doubled down on is their share count. It's up fivefold.
Thank you. Yeah, you're right. It's a disaster,
in the last 5 years. And it looks like one of those stories where one of those stocks where the story's changed. There's been multiple acquisitions. I think they acquired Big Air.
They bought Big
Air. As you said, the new management team, and to hear that that they have no accountability to the prior mistakes, and seeing the share price fall from $3 down to 70 cents, and all this destruction of value for their shareholders it's quite disappointing. It seems like an obvious avoid.
Yeah, avoid is too nice a word. I just run really far and really fast from that one.
Double avoid.
Yeah, I'm sure we'll get letters from them, but yeah, I'm happy to read them. All right, so let's do. Should we do a break, or Nick? I'm really keen to hear from you about this. Let's leave from you, Nick, because I think you've got a fascinating story to talk about. Nick's been doing some work on Nvidia and wrote a cracking article. I thought one of the best pieces I've read on Nvidia, and there's been so many people writing so much on it. So this was great, Nick. So tell us, first of all, why is this stock worth looking at, and what did you discover when looking at it?
Yeah, well, I mean, like everyone else, I guess what piqued my interest was just how much hype was behind this one story. It's $1 trillion business now, Nvidia.
Just say that again. It's $1 trillion business.
Yeah.
I looked at this briefly a few years ago. It was only $100 billion. And even then it looked like a big, expensive business. And it's 10 bags since then. It's incredible.
It's 10 bags since then. And I think it's in 100 baggers since 2013 or 2014.
Wow.
Which is just incredible over that short a time period. But if you even rewind back to last October, the stock's up, I think, 4 or 5-fold.
Since October?
Since October last year, yeah. So
I didn't know that. Wow.
if you put numbers behind that, it's a $200 billion or $250 billion business going to well over $1 trillion. It's just got another planet.
Yeah.
But why it's interesting is Nvidia are a monopoly, a virtual monopoly in graphic processing units or GPUs. And this is important right now because these chips are used to improve and train artificial intelligence models and applications. And that's where a lot of the hype behind the share price has come from. But you are now starting to see that come through in actual financial performance. This isn't just hype with, no substance. There is a lot of substance behind this. And even at $1 trillion valuations, there's scenarios where this share price could actually be good value.
Wow.
So it's not. It's not a stock to write off just because it's up, tenfold in the last couple of years or fivefold in the last year.
So, Nick, when you say the financials are coming through, are you talking about revenue or profit or free cash flow? I mean, what numbers are improving?
All of the above. So,
right, okay.
I guess if we rewind a bit, I might just go back to where this business started. So, Nvidia was originally designed GPUs were originally designed to improve gaming. And this was in the early 90s, mid-90s. Previous technologies relied on central processing units or CPUs that are dominated by Intel and Advanced Micro Devices or AMD. And they use something called sequential processing or one task at a time. And that was...
Please, I know what sequential processing is. You don't have to patronize us.
We're not in grade 2.
Yes.
Well, anyway, that delivered really poor performance for gaming. And then GPU came along and they did parallel processing, which is just allowed simultaneous calculations and rendering of graphics in real time. And it made for a much more realistic gaming experience. This was actually a pretty crap business because there was about 90 competitors, gross margins were in the 30s, and it was very cyclical around PC launches and console launches. Fast forward a decade into the mid-2000s or the early 2000s, and researchers actually realized buying a GPU from Best Buy was actually better at calculating large data sets than Stanford's supercomputer.
Wow.
Which is kind of amazing for a couple of $100 off the shelf. So that was the aha moment for Nvidia, and they were very worried about if they pursued data centers and artificial intelligence and this new revenue stream, that it would turn into gaming again. It'll be just a cyclical business with lots of competitors. So they developed something called Coda, which is, in layman's terms, a programming software layer that locks in developers, because only by using Coda, you can only use it on GPUs made by Nvidia. And so when you use this software, you can manipulate the GPU to really improve the performance of the application you're creating. So medical images or weather forecasting or training a large language model like ChatGPT. And that's what's really, I guess that's why the stock's 100 bagged in the last 10 years, because this is now a reality. So data center revenue, which is tied into artificial intelligence, has risen from $300 million in 2015 to $15 billion in 2022.
Wow. Okay.
Yeah. And because there's a massive switching cost, gross margins have gone from 30% to 65 or 70%.
Right. Wow.
And operating profit margins, I think, are now kind of close to 30 or 40% what they were previously, or what they were under the gaming, where gaming was the main use for GPUs. So it's been an incredible turnaround in the fortunes of this industry and the fortunes of one company. And now they're seen as the industry standard, the picks and shovels for this AI revolution, in the same way that Cisco was seen as the hardware solution for the .com era.
the other thing that they've managed to do is they've become the central node for the AI narrative. So if anyone's thinking, oh my goodness, this AI thing is huge, I gotta buy some AI stock. This is the default AI stock. In the way that Tesla became the default EV stock, and Cisco became the default internet stock. Sometimes no one teaches you this stuff, but might be worth learning how to identify some of these meme stock potentials. The gains just seem to be incredible, and it's a source of great frustration that we sit here with our years of training, the hours we spent analyzing stocks, and all the time and effort and struggle, doubt, and then just some meme stock kind of goes up 10 times. I'm not.
But I think Nvidia is more than a meme stock. I'm not necessarily. It's really got something there.
Yeah. Not necessarily saying that this is the meme, but these stocks that become the defining feature of a narrative, they just go bonkers, and often they don't have anything. It sounds like in this case that they actually do. Just another question for you, Nick. Just on the volume of chips, I was reading that it's not just the software that locks the developers into Nvidia chips, but the chips work better when you get a whole bunch of them working simultaneously. So do you have numbers for the change in chip numbers or any forecasts for what that might happen?
I don't, and I don't think they released them.
Okay.
But one of I think their H100 chip, which is the latest model, that can cost around $40,000 US.
Oh wow!
Chip.
Okay. Yeah.
And then I think you can pair about 8 of them together for around a bit over $200,000
right.
US dollars. So it's incredibly expensive.
Well, some of these
there's no real competition. AMD are making some inroads, but still it's mainly Nvidia for now.
I know some of these data center guys, they're talking about chip orders in the tens of thousands, for a single site. So there's just, it's that combination of software locking in the Nvidia as the supplier, and then the kind of tailwind just exploding the number of, causing explosion in the number of chips demanded. It's such a great place to be.
Yeah, absolutely. Just one stat on that, is ChatGPT used 10,000 NVIDIA chips to train their AI model.
Yeah,
That's
right.
just one application or one model. It's a great model, but it's just one.
Yeah. And every large tech business is now building their own AI model.
It's an arms race. It's like, it's an absolute arms race to get your hands on NVIDIA chips, because they can't make them as quickly as they're flying off the shelf.
Do you have some idea about the prospect for competition? Imagine, Apple came from nowhere to be a significant chip designer, and there are companies with resources like Apple, several of them, many of them, in fact. What are the chances that someone can break this monopoly?
I still think it's low, but they are trying. So Google and Amazon seem to be the most advanced. I think Amazon uses their Graviton chip, and Google uses Tensor. So they have designed and made their own chips specifically for their own cloud and for certain workloads. Now, they still need a lot of NVIDIA chips for other areas, but there's no doubt that these, monopolies in other areas are realizing that NVIDIA is a monopoly, and we need to look at this kind of quickly. Otherwise, they'll be just completely beholden to them. In the same way that before Apple did the M1 chip, that they were a little bit beholden to Intel.
Yeah. And I understand that Nvidia actually gets all its chips manufactured from one company.
Yes.
Is that
TSMC?
Yeah. Is that an
monopoly over monopoly over monopoly?
Incredible, right? And TSMC gets a lot of its physical equipment from some Netherlands based
ASML.
All the names. I know the stories. You know the names.
Who's at the end of the line?
It's just incredible.
There's duopolies and monopolies all throughout the semiconductor industry. There's been a massive consolidation over the last 10 years, and that's just coming back to the supplier TSMC. They make want to say 90% of the world's most advanced chips at the moment, or manufacture 90% of the world's most advanced chips. The other one is Samsung. Intel, that was involved, that's still involved, has spent tens of billions of dollars trying to catch up, and they haven't managed to do it. I mean, they're still getting tens of billions of dollars in subsidies from the US government and to catch up, and they can't muster it. There's a lot of intellectual IP here that money can't buy. And I guess that's another risk for Nvidia, is they rely on one sole supplier, which is TSMC, and they're based in Taiwan, and that obviously comes with several geopolitical risks.
Where in that value chain would you like to be most? Who do you think captures it? Because as you said, that's like the three, monopoly. Are they all making mega profits, or where would you ideally sit in that entire chain?
It's a good question. I think probably Nvidia, if they can maintain their monopoly, which is the big if. I'm more confident that ASML and TSMC will be a monopoly in 10 years than I am probably Nvidia. But ASML and TSMC require lots of capital expenditure. Right. To manufacture their equipment and manufacture these chips. So a large foundry, they call them for TSMC, can cost $10 billion. So it's huge amounts of capex. Whereas Nvidia, by being what they call a fabless company and not owning their own manufacturing facilities, are very capital light. So there's not as much capital expenditure. So free cash flow is powerful.
Amazing. Nick, this is one of the most fascinating industries in the world. I'd like actually one day for you to write a book about this, because Chip Wars, which is the default, is a crappy read. It makes a fantastic, exciting industry just a dull, boring read. So there's room in the market there. I think you might be the man.
Perfect. I'll get on beating a bestseller in my spare time.
Well, you've got the filing cabinet for it, that's for sure. Keep all your notes in there. Now, we're going to take another quick break, and we'll be back for a final segment.
Gaurav, I don't think you have to keep telling people you're having a break. Just stop talking. And
Okay. Sorry.
But doesn't that sound a bit weird if it just suddenly cuts out and it goes to a break?
Yeah.
Yes, Steph. Geez.
No.
Get with it. Get
as long
onto
as
it.
your intonation goes down and it's clear that you're ending a topic or sentence, we can stitch it in. But you don't have to make like a big announcement about an ad every time an ad kind of coming. Just zip it.
All right, we'll do it next time. Graham, we have an interesting question that we ought to discuss.
Yeah, so this is our segment on on member questions that we now are very religiously going to adhere to. Yes. We had a question come in from Sonal this morning, who, I won't read the whole thing out, but essentially she said that she prefers to buy stocks that are in the $1 to $20 mark instead of the $100 to $200 mark. And I think it's an interesting point, because her reasoning was that stocks with a lower share price then have more room to grow, because you just have to add an extra $1 and suddenly you've doubled it. Whereas for a $100 stock, adding an extra $1 is just a 1% gain. And I think it actually gets to a very common myth in investing. Definitely early investors can fall for it. I did. Many other people that I've spoken to seem to have had that experience too, where you feel that the share price itself is somehow going to reflect what the opportunity is ahead of it. So the kind of typical thing are these kind of 1 cent stocks, where you think that if you buy a stock that's only worth a cent, then that has a much bigger chance of growing because it is so low to start with. And the point is that isn't really the case, that the share price can be manipulated by management, by things like stock splits or share buybacks or new stock issuances, as Star reminds us. But that share price can be controlled to some extent, not kind of in day-to-day movements, but there's definitely an element of control from management of whether they want a $100 stock, a $20 stock, or a $1 stock, or a 1 cent stock. So yeah, it has nothing to do with the company's underlying value. and it doesn't have anything to do with the ability of the stock to grow, but it does reflect whether management want a particular kind of ballpark figure for where their share price should be. What are your guys' experience with that? Did you have
Nick?
that same experience?
Nick?
I didn't. I think I sort of grew up looking at Berkshire Hathaway a lot, and there's so much literature around why they weren't doing stock splits, and that share price went from 300 to 1,000. I think now it's at 500,000 or maybe even 700,000 for the A-class shares. So I
It's a
guess,
good example.
yeah, having that in the back of my mind, I never really looked at it that way, but I've certainly heard that from other people, and it is probably a common error that individual investors face.
I must admit, it never occurred to me to think about it that way, but I can see how that would happen. I can see why it would be tempting to think that way.
But so I'm kind of curious if it didn't happen for you guys, because I always kind of assumed that this was just a progression of investing knowledge. How would you have known that it wasn't the case if you hadn't already learned about stock splits, share buybacks, things like that? Because I know that when I first started, I mean, this is going back to like pre-teens, I didn't quite make the link that the share number, that the share count can change, that the value of each share can then change because the number of shares on issue can each change. So how would you how did you come to it? Maybe it was just a quicker learning curve.
I think like most early investors, I was very quantitative and numbers focused when I started investing. And I always looked at stocks in terms of market cap. So how much profit am I getting for this market cap? And I used to calculate all these ratios, and then that's the way I looked at it. And then the share price would just become a function of the market cap. I never broke that link that the share price is a function of the market cap. I didn't realize that you could separate those two. They all seem to very logically sound to me. But I did economics and finance, and so I had that knowledge from very, very early on. I suppose if you don't have that knowledge early on and you're looking at share prices every day, then that's the way you tend to see value in terms of the share price. And that's just, you want to break that habit as early as you can. It's just such a dangerous way to invest, just psychologically, seeing prices moving up and down rather than the fortunes of real companies, real businesses changing.
Yeah, definitely. I think that's maybe one of the most important lessons you can get in investing, is that the value isn't the share price. They're two separate things, and your job is to work out, is the difference big enough that it offers a margin of safety for you to invest? Yep.
No, you're right. I was just going to make this point, Nick, and I'll throw it to you. The single most important lesson for any newish investor to learn is to think about stocks as businesses and not in terms of shares. You're buying a piece of the business. It's the most important lesson. Sorry, Nick, to cut you off there. Go ahead.
No, this came up recently in the pandemic with a few of my friends that had seen Webjet and a few other shares halve or down 80%, and they thought, oh well, travel's going to recover, which it has. That was a sound, rational thought, and that these share prices could recover to their previous highs. But they didn't realise that actually they're gone and diluted themselves, or these companies had diluted themselves 50 or 60%. So it's an important point to, and we've talked a lot about dilution and what it does to future returns this podcast.
That pie can be split many times over. They can just keep cutting smaller slices for you.
Nah, making me hungry, Graham. Pies and slices. It's getting close to lunchtime. We want to wrap this up, but Graham, in that question, there was also a point that I wanted to address that you haven't read out yet. But there was the Sonal also asked about there only being 6 stocks on the buy list and expressing some disappointment that we couldn't find more stuff to buy. And I just wanted to address that, and I'll give you guys a chance to say something about that as well. But I think I just wanted to highlight that there are really two times that we really earn our money in this business. One is staying incredibly disciplined when markets are rising and people are getting carried away and valuations look high, we earn our keep by doing nothing. Like doing little in those times is incredibly difficult and incredibly valuable. And I would suggest that we're doing our jobs by maintaining discipline and not searching for things to put on the buy list, to have things on the buy list. We've maintained discipline and only upgrading things as they become, as value appears, and having disregard for the business, really, because I know everyone is aware that it looks terrible that we have very few buys. So we live and breathe by subscriber numbers, and it's not good for business to have such a small buy list. But I think we're doing the right thing there by maintaining discipline. The other time we earn our food, we earn our dollars, is when there's panic and blood, and that's a chance to upgrade. And I think the team did that brilliantly during the COVID crisis. We had a buy list of almost 40 stocks at that stage, the most we've ever had. And that's equally correct. I know even that's not great for business, right? You don't want to be confusing members with a huge amount of potential stocks to buy, but that's also the right move. So those two times, being aggressive when everyone's fearful, being disciplined when everyone's aggressive, this is when we earn our keep. And I think we're doing the right thing. I understand that from a member's point of view, it's not ideal. You want more things to buy. I'm sure you've got a portfolio you want to fill. You have goals you want to reach. This is a long game, and I think what we're doing is right here, and I hope that's clear.
Yeah, and I think also portfolios are constructed. Well, the best portfolios aren't constructed kind of in one sweep. Sometimes you might might suddenly inherit some money or something or other that means that you do need to suddenly put a lot of capital to work at once. But It's okay to take your time. That, like, if you buy your favorite stocks on our buy list now, and then a few more at the end of the year, and then a few more mid next year or something like that, you can build a portfolio over time. And it does kind of, the buy list does breathe in a sense. There's very often these increases and decreases in the number of stocks. And you got to kind of roll with that you pick your favorites and what you understand the best, of the investment case that you find the best at each particular time. But your portfolio itself probably shouldn't be suddenly going to 3 stocks, suddenly going to 40 stocks or whatever. You're better off to buy and hold for the long term, and then add them gradually as those opportunities kind of present themselves.
Nick, anything to add?
I mean, to me, if I just look at my personal portfolio, it's very similar in terms of probably holding more cash than I have done probably ever. And that's not a call on the macro environment or interest rates rising or anything to do with that. It's just some of the previous positions that I held have risen to valuations that I thought were too high. And so I've sold some, and I haven't found new opportunities to redeploy that capital. But I haven't felt like I've been forced to do it. Money's earning 5% in the bank at the moment, so it's not the end of the world. But I think remaining disciplined when valuations are high is just so important. I think John might have mentioned maybe on an earlier podcast that when the buy list generally shrinks, it's been a pretty good indicator that valuation's quite high.
I'll also throw a tease out there that from the stocks I cover, Lovisa, Mac Telecom, Minres, and RPM Global, probably 4 of my top 5 positions, they're all within a whisker of being upgraded, less than 10%. Sometimes, a couple of percentage points of being upgraded. So there are a lot of decent businesses just on the brink. And
Auckland Airport too, we throw that one in there.
Yep, that's a good one as well, Graham. So if we stay patient and you can also act without us pulling an official trigger. We actually have to have lines in the sand, but in reality, you want to be slowly entering and exiting well before I think those lines in the sand are crossed. If you're a more experienced investor, you should be able to do that. But because we're running a service for thousands of people, we have to wait for those lines in the sand to be crossed. Yeah, waiting for one day maybe Nvidia. That sounds incredible. Nick, I'm going to pay more attention to that in future. But let's leave it there, shall we? Nick, thank you very much for your time this morning.
Thanks, Gaurav. Thanks, Frank.
Graham, we're going to go grab some pie. I think it's a good idea. You put the idea in my head.
I'll give you a tiny, tiny slice.
And for everyone else, thank you for listening.